Hello, my name is Cathy Russell and I'm one of Canada Life's tax and estate planning consultants who works within the ICANN Technical Services team. This presentation is part 2, a brief introduction to collectives. I'm going to run through the taxation of collectives and the advantages and disadvantages, and hopefully, once you've watched part 1 on bonds as well, you'll have sufficient information to demonstrate that there is no definitive answer which fits all clients. It has to be looked at on a case-by-case basis. If you would like any further information, please see the attached contact sheet or email us directly via the presentation link. Now on to the presentation. When we look at the taxation implications, collectives are liable to income tax and capital gains tax. Within the collectives fund, this is exempt from any tax on gains. Any UK dividends are distributed to the investor, possibly every 3 or 6 months, or accumulation units may be used so the dividends are automatically reinvested. Any other income, such as rent or interest, is subject to 20% tax. Let's look at investor taxation, and we'll start with income tax. This is a variable income which is taxed on a rising basis year on year, and this does include accumulation units as well as income units. Some people wrongly assume that because they haven't physically received the income, they don't need to declare it for tax purposes. If we look at equity collectives, there is no tax deducted by the collectives provider. Individual investors can use the £2,000 tax-free dividend allowance before being liable to tax at their marginal rate. The marginal rates are 7.5% for basic rate taxpayers, 32.5% for higher rate taxpayers, and 38.1% for additional rate taxpayers. If we look at a corporate bond or fixed interest type collective, these used to come with a notional tax credit of 20%, but these are now paid gross for dividends and interest. However, property funds will remain subject to 20%. This is reclaimable by non-taxpayers, including those with unused starting rate band or personal savings allowance. The 20% notional tax credit deducted at source does meet the liability of basic rate taxpayers. However, higher rate taxpayers have to pay an extra 20% of the grossed up distribution, and additional rate taxpayers have to pay an additional 25% of that grossed up distribution. Moving on now to capital gains tax, we all know that capital profit is taxed when realised. However, every individual has an annual exemption, currently $12,300 in the 2021 tax year. That's for individuals. If it's trustees of a trust, they have a maximum of $6,150. I say maximum because this is shared amongst all discretionary trusts that a settler has in a particular year, down to a minimum of 1/5. So $1,230 in the 2021 tax year. When we come to disposals, non-taxpayers, basic rate taxpayers pay 10% on any gains in excess of the annual exemption. Higher rate taxpayers, additional rate taxpayers, trustees and personal representatives all pay 20% on any gains in excess of the annual exemption. Let's look now at when is investor tax assessed. Well, on collectives, it's when any dividends or interest is paid. The tax would be assessed in that same tax year. On disposals, remember that does include switching funds. If any taxable gain arises, then the tax is also assessed in that same tax year. If a client wishes to take a regular income from any collective, apart from taking any natural income which is produced, he could instead take that as a partial withdrawal of capital by using the part disposal formula. This is commonly called the A over A plus B formula. What we're going to do is to calculate how much of the withdrawal is actually original capital so that we can then determine the capital gains tax position. The purchase price is the original investment, A being the capital amount the investor is withdrawn and what is being disposed of, and B being what's left in the investment after the withdrawal has been taken. If you think of the original capital as a circle, which looks like a cake, and then each year the gain is represented by a ring around that circle, when you take a withdrawal at the end of year one, you're getting a slice of the cake, which contains some of the original capital and some of the gain. By using this formula, you can deduct the portion of original capital from the total withdrawal to determine how much gain will be set against your annual exemption. Here's a quick example. A client invests $400,000. We'll assume that the fund grows by 4% per annum after charges and he has his full CGT annual exemption available. At the end of year one, he wishes to take a £15,000 withdrawal. Remember, the formula was purchase price times A over A plus B. Therefore, from a £15,000 withdrawal, we can see that £14,423 is actually return of capital, and that means the gain is only £577 to offset against his annual exemption of £12,300. Coming back to our example where the withdrawal contains some original capital and some gain, we now know that the original capital returned was £14,423 and the portion relating to the gain was just £577. Remember that each year you have to rebase the purchase price by deducting the amount of original capital already returned. So, at the end of year two, the purchase price would be $400,000 minus $14,423, giving you a rebased value of $385,577. This rebasing would need to be done every time there was a withdrawal. Let's look at their advantages. An obvious advantage is that they can produce income or capital appreciation, or indeed both. The client actually sees something coming out of their investment and may feel psychologically comfortable about that. Therefore, if we're looking at a trust that requires income to be paid, say to adult beneficiaries, or a situation where a separation of income and capital is required, clearly a collective could be appropriate. Some collectives are run on a fund-of-fund basis, whereby the fund manager is able to alter the investments when he chooses without triggering a tax event, rather like through a life assurance contract. Therefore, it is possible to professionally manage and review the portfolio without any CGT consideration, although the investor arguably loses an element of control. You have the ability to use the CGT annual exemption, and as I've just shown you, you can also use the part disposal formula. You can offset any losses or carry them forward to future years. And of course, you get the CGT uplift on death, as any CGT liability dies with the owner. On to the disadvantages of collectives, and although I've said with a fund of funds there is the ability to restructure an investment portfolio without taxation, if the client is actually going to swap one particular unit trust or one particular fund for another, then clearly that is a tax event which could give rise to a tax liability. In some cases, having a tax event could be seen as an advantage if we're making sure it is within the CGT allowance, as it enables the base value to be uplifted tax-free, thus minimising any future gains. Because collectives generate income generally and from time to time capital gains, clearly administration becomes more cumbersome. Of course, if gains are significant, then the reliefs and exemptions could be exceeded such that a tax liability could arise. This leads to more onerous self-assessment. With dividend income, the tax calculations become complex, especially for trustees of a discretionary trust that regularly distributes its dividend income to the beneficiaries. The dividend allowance is not available for distributions from a discretionary trust. To avoid capital gains tax by moving abroad, you would have to be non-resident for at least 5 tax years. So, in summary, when it comes to making a decision, should we use bonds or collectives, remember to look at each case on its own merits. What is the purpose of the investment? What is the client looking to achieve? And what are the client's own circumstances? We need to consider the various points shown here. What is the time horizon of the investments? Is the client going to be encashing the investment in a fairly short period of time? That could mean that collectives is more suitable than an investment bond. What about how actively the investment will be managed? Remember that every time a client switches out of one collective and into another, that is a tax event for CGT purposes. Is the client looking for income or growth? With collectives, they can choose funds that either produce natural income or produce growth. What about their allowances and exemptions? Remember, if these are already being used, they can't be used twice. And think about the assumptions you're going to use for the client's tax rates on any gains or income going forward. And do consider if the tax position of the client will change by the time they need to take a withdrawal. One thing to remember is don't isolate tax as the sole factor when making the decision. There are different ways to take money out of a collective portfolio, and the rate of CGT applicable does depend on other income. Remember that bonds and collectives are very different structures, so do look at each case on a case-by-case basis. In the first instance, contact your local account manager for support on specific cases or general principles surrounding tax and estate planning for both UK and international products, including any trusts. For further information, please see the attached contact sheet or email us directly via the presentation link.